Good afternoon, good morning, everyone. Welcome to Elite Currency. My name is Chris. Thank you for joining us. We're going to take a look at Forex Wizz, which is a script or a tool basically to help me and Nanette look for targets. And those targets are based on Fibonacci. So maybe you've heard of it before. Maybe you already have the script and you've been using it. Perhaps you're new. We're going to talk about how to use it, how to install it, and what are the benefits of that. And on the page that you're probably looking at this webinar right now, you, for instance, understand that we're going to take a look at how it benefits you, for instance. Let me pull up this page where you can see that a bit better. Right here, this is our schedule for today. And we're going to take a look at, for instance, how traders can use it to benefit their trading for targets, learn how traders can use it for entries, learn where to expect impulsive price action versus choppy moments. We're talking about this part right in here. Learn when to expect bigger wins and let winners run, and learn which level is the key breakout level for trends and ranges. All right, so that was a bit quick, but basically to summarize it, where are the targets? Where are potential entries? Where can we expect the big impulse to occur? And when do we expect actually choppiness, which means where can we expect the winners to be larger and where we can let them run, of course, in those impulsive parts. And where is the distinction? Where can we expect the difference between chop and impulse? What is that key breakout level? All right, so that's basically it. Entries, exits, and the space for impulse, or where does it stay, choppiness. That's what we're going to take a look at. And it's very important because many FX experts, I would say 99.99% of them, agree in general that letting your winners run is a very key component of getting a very good equity curve and letting it have a positive slope for a month, week, year, etc. But how do you do that? Not many discuss how can you really let a winner run. It's just one of those things that are said, during a webinar, but not really attention is giving. Like, okay, how do I do that, right? What we want to do is really different. We want to show how that can be done using this script or tool that we can effectively find those zones and let those winners run. Finally, an answer to that question. So, just in case you're wondering, you can find this particular, you're probably watching live, but anyone who's watching the recording, you can find that by going to our website, elitecurrency.com, clicking on free webinars. Not only will you find live webinars on FX topic, what we're doing right now, but on Monday, November the 2nd, we're going to take a live talks with an FX expert. In this case, Dale Pinkert from FX Street. So you can click on that tab and you'll see that those webinars lined up as well with the experts, FX experts. We get a range of different views. You can learn something from that and see what the experts have to say to us, and you can learn from that. So definitely recommend taking a look on Monday as well. Besides, of course, also Admiral Markets webinars, which we have each week. And you can click on that link and you'll find out where you can register as well, or you can go to Admiral Markets website very easily like this and go to education and webinars, and we got Monday, Tuesday, Wednesday, Thursday, all kind of webinars lined up. All right. So today is the last day of the month, so I thought it would be to have a webinar and talk to you. It's also, let's see, November, December. No, it's not the last day of the quarter, but still, last day of the month. So market, can be quite choppy, can be a bit volatile, too much for my liking. So one of the reasons that I'm not a big fan. Now I hope that the screen sharing is working here. It doesn't seem to. Let me try to get that working here. Oh, I think it is working actually. Sorry, it is working. Okay, good. Well, Before I start, let me explain to you that you can reach us because we don't have a chat function here, unfortunately, but you can communicate with us if you want to have any questions about this process. First of all, you can email address here about this process, either now, live, or after the fact, or if you're watching this recording, doesn't matter. Yes, there will be a recording. You can watch it anytime after this webinar. Again, of course, if some of the things are maybe not as clear. So what is the Wizz, first of all? What is Forex Wizz? What kind of thing is it? What are we talking about? And stuff like that. Well, Forex Wizz is based on Fibonacci levels and not the ones that you're used to. Fibonacci tool is something you have and you drag it from top to bottom like this. And you have ratios. 23.6 Fib ratios are calculated on, right? What are the Fib? Well, they're 0, 1, 1, 2, 3, 5, 8, 35, 44, 233, 377, 6. And you get these ratios by dividing, right, as you probably know. Now, as you can see here, price with this euro, I went down to the minus 272 target. One example of Fib ratios and targets. But in this case, we're going to do it differently. This tool doesn't use the standard retracements and targets. It's not a tool like that. We are using the Fibonacci numbers, but in a different way. We're actually using the sequence itself, the levels of the sequence. So we're using actually those numbers. We're using 13, we're using 21, 35, right? But in terms of pips. So let me show you on the chart. Let's draw a horizontal line at the top, and let me measure down from there. The horizontal is 114.95. So 55 pips from it, we go down to 114.40. So I need to that's all right. So the difference between the top, let me make it a bit different color otherwise. Dark red line here is 55 pips. The difference between those two lines. Okay. That's basically how the tool is using the Fibonacci sequence numbers. It's calculating the Fib sequence levels by just subtracting and adding those pips from the top or bottom. So the first level, for instance, in this case here, is 55 pips lower than the pink level, right? So that's an important level because it's a Fibonacci level. And 89, 144, 233, 377 are also important levels. So all it does, I just wanted to change this color here. There we go. All right. All it does is from, and it measures the Fibonacci levels, the sequence levels from that top or bottom. Now, you might think, why would that be important? What advantage does that have? It has a big advantage. I'll talk about that in a second. But sure that you understand. So let me use the tool now for the first time, and I'll get rid of these levels. Anyone can use these levels by just measuring the distance of pips away from a top or bottom and putting these lines in the chart. Very simple. There's no magic formula, no black box, nothing hidden here, right? It's all very plain, very logical process. It's all about the Fibonacci sequence level, counting them. Now, what we did was, and you know, we're explaining this to you. Many would not explain this because they would rather talk about very valuable information, because we want you to know, because it's a very, you know, is because we don't want to always calculate those levels of fibs on the charts. Is we made a script that does that automatically, just to simplify our lives. That's what we did for our own trading. All right, so I'm going to use that same tool to calculate those levels. So what I do is, you can see it's a script. I'll show you later on in the webinar how to put it there. And you drag it on the chart like this. And what I'm looking for is downside targets, because I'm looking at a top. What you do is click sell, because I'm looking for downside targets. And I click OK. And I get lines here, right, as you can see, the Fibonacci levels. So I hope that this is clear. And now in this case, because it's an hour chart or higher, you can see first level, a second level, a third level, a fourth level, a fifth level, and a sixth level. For a 1 hour chart and higher, this represents 55 pips. The first level represents 55 pips from the pink line, which is the baseline. The second one is 89. The third is 144. The fourth is 233. The fifth is 377. And the sixth is 610. The seventh will be 987. It continues, just like the Fibonacci sequence level continues, okay? But with the 1 hour chart and higher, we start with 55. Because, why? Because the first levels are not important. 1, 1, 2, 3, 5, 8, 13, 21, 34 really don't represent much movement on an hour chart or higher. You would see only a clustering of levels, and it would become not so visibly pleasant. That's why I start with 55, because that's really the first level that matters a bit on the hour chart. And maybe on the 4 hour chart, the 89 matters a bit, all right? From a daily chart, actually, I would probably start counting from 233 and ignore the first three, right, if you use it on the daily. But I use mostly on the hourly chart and 4 hour chart. If you do use it on the daily, skip 1, 2, 3 green here and start with green 4. And that represents actually on the daily chart the first level. Now on a 50-minute chart, that's a bit different, because then the movements are smaller. So in the counting at a different level. Of course, I upside. And what I then see is actually the same levels again. You see, I mean, the same lines, right? 1, 2, 3, 4, 5, 6, 7 as well. You just don't see it, but different fib levels. With a 30-minute chart, a 50-minute chart, a 5-minute chart, I don't start with 55, but I start with 13. Then it's 21, then it's 34, then it's 55. So 55 is the first level for an hour chart, but it's actually the fourth level for lower time frames. Why? Because obviously 55 pips represents a decent movement on the low time frame, but not on a higher time frame. So the fifth level here is 89, the sixth level is 144. Alrighty. So that's basically. Now let's think how to use these levels. I think that what these levels represent, how they're calculated. Remember, all the first level it means is that there are 13 pips gap between the first level and pink. The second purple level, all it means is there 21 pips gap between the second level and pink. All the third level means is that there are 34 pips gap between the third level and pink. That's what it represents. And you understand that all these levels represent different pip levels on those time frames. No matter what time frame you're looking at, though, the first level, the second, the third, the fourth, it's important for me to count the level away from the pink one. So this is first, 2, 3, 4, 5, 6. Every time from now on, when I'm talking about the third level or I'm talking about the fifth level, means that I'm counting the purple lines, the distance, a number of purple lines away from the pink one. Okay? So now we've been talking about the basics. Let's talk about how to use this tool. All right? Let me go back to this hourly chart. Or we can even stay on this 50-minute chart. Targets. One of these levels has a high targets. If I'm looking for upside, right, and price is still below the horizontal levels, then the next level could be a target. For instance, if we are here, if price is this level is a target. This level is a target. This is the first target. This is the second target. So when price is bouncing off this level, the next target is this. Then the next target is that, right? But if price is above it, obviously here you can see price is above the first three levels. And you can see in those cases, sometimes it's used as support. Sometimes. And I'll explain when and why I use it as support or resistance. I just want to make clear that obviously if you're looking for upside, that if the levels are below you, it's support. If they're above you, it's resistance. Common sense for those that have been trading for a bit, right? So if price is above it, if there's obviously we're looking for targets. If we're looking for targets, we're looking for levels that are still not broken and above us. In this case, this level has not been broken yet. This level has not been broken yet. So those are valid targets. But here, price is punched through it. So in this case, that's not a target anymore. This is not a target anymore. The next target is here. Just a general principle of understanding, all right? So you can use those levels to understand, okay, I know what the next target is. Will price always stop there right at that spot? No. It's not that precise. The market is not that perfect. But I do dare to say that many times price is relatively pretty accurate and does stop around that level. And it's a pretty interesting to see how well that works. For instance, here, look at that precise touch right on that euro dollar upside target. The fifth level being hit to the penny, to the pip, as you can see. And no, I didn't cherry pick this target or this chart. I didn't even look and put this tool on this 15-minute chart. Now, is it always like that? No, look here, it went through it, right? That can happen too. Here you see it stops at the third level, but on the fourth one it didn't, the fifth one it did. Right? Those things happen. But in general, I would say it's a fairly good, accurate tool, and it's very nice how those targets are used. That's one thing. That's how you can benefit from this script for seeking targets. Now I want to talk a bit more about entries, how to expect and where to expect those bigger runs, right? When to expect impulse, and what is the key level for breakout territory? Because that's really the essential part, I would say. These are just still basic concepts. All right, let me move the chart now to something different so we see something else, okay? And let me look here with this. Sorry, I just moved this email address so you can always ask a question. Giving me a bit of a headache there. All right, let's try it this way. Good. All right. All righty. So let me just put on that tool one more time. All right. So once again, you just want to drag upside targets. You click on. If you're looking for upside, you leave it on buy. All right. So let's take a look at this. This is level 1, 2, 3, 4, 5, and 6. Right. Now, I'll leave those numbers on here so you can see that easily. All right. What I expect is the key. Let's first talk about the key breakout level. What's the difference between a trend and an impulse and a range territory or corrective territory? In my opinion, I've noticed that the third level, and tested that the third level is key. The third level is key. If it stays below the third level or above it, in this case above it, measured from a top, in this case, right, from here, if it stays above it, price is still in a sideways or corrective mode. It needs to break below the third level, in this case in a downtrend, or above the third level in an uptrend, before we can expect price to make a bigger acceleration and impulse. Third level, very high chance that that's the key breakout level. What that means is that we have, depending on the higher time frame too a bit, to be honest, but we should have space down to level 5, level 4, and 5. Now I say depending on the higher time frame because sometimes a level 4 can stop it. Most of the time, if the higher time frames are in a downtrend too, or the trend is aligned, price should go to the 5th level. In this case, you can see euro dollar was already in a downtrend, or at least had a lot of downtrend in the past year. And you can see when level 3 broke, boom. Not only to level 4, boom, way down to level 5, and actually even further, although that took some time. But you can see where was the impulse. Very, very, very quick acceleration here in level 4 and 5. Now, true, this is maybe not a good example because you can say, yeah, it was news driven, whatever. And that's right, it was. And we're going to look at other examples. But I just want to make the principle clear. It's not about using this example and, meaning that this is therefore for sure perfect. I've had very good experience with it and done a lot of testing. And I'm explaining my experience to you regarding that. That's all. But you have to be aware that you always have to do your own testing and your own calculations and your own experiences. And this is how I see it. And this example is just to show you the principle as is, right? Not to only use this one example and say that's it, but just to explain it. Right? Now, from that point of view, I should also make you aware, because now we're getting into more sensitive material. So far, I was only explaining the basics, right? But now we're going into sensitive material, which merits a risk disclaimer. That's why we want to warn you the fact that trading for exchange and global financial markets is considered high risk and may not be suitable for everyone. Therefore, please seek the advice of an independent financial advisor for more information on that. This video and webinar recording is for educational and informational purposes only. And by continuing watching this video, you agree with this disclaimer and you are aware of the risks involved when trading. All right, you can pause the video here or stop watching if you disagree with that or want to read this in more detail. All right. Yeah, because now we're getting into material where I'm sure, right? That's the key idea here, is that from the 3rd level down to the 5th level is where you can expect an impulse. And this is how it looks like. And we'll show you more examples in a second, but this is often what happens here, and you can see the benefit. Obviously, if you don't know about these levels, if you're not aware of them, then you can't count or don't even know when this run or big impulse is going to happen. But if you know, hey, look, the third level is broken, and we're in a consolidation here. Ooh, I'm in a short. I'm going to take a short. I'm going to leave that short because I'm expecting that big impulse, and boom, look at that fall. And this happens often with the break of the third level. And we're talking about on our from the third level to fifth level, you're talking really about hundreds of pips of movement. Now, compare that to a trader that might exit at 30 pips, 20 pips, and a trader that relies on a 200 pip movement. The equity curve has a lot of ups and downs. With some few losses, some few wins, and it's kind of like, right, like this, stuff like that, right? It's not always a pleasant like swing to the upside, and that's why sometimes having a good boost with a one big trade can do a lot because it brings you into a new territory of your equity curve. All right, so that's so pleasant with that. With these bigger wins. All right, let's keep. Now, everything above the third level is more of a range of correction, right? But sometimes price does still respect it. Look at the respect to your level 1. Look at the respect at level 3. The poke through it here, what I'm looking for a break is a good candle below it. That's what I consider a break. So a candle like that here, that's what I consider a breakout candle. That's when I consider that level broken. And I use fractals often enough. Let's add fractals to show the tops and bottoms a bit better. There we go. And you can see when we break these bottoms right in here, that's when we start the breakout trade. Okay, so that's what I consider a break of the third level. Now, often enough, when price is going to these levels, it will stop and make a pullback. So what happens is that if it's at the third level, it will go back to the second level or the first level, right? If it goes above the first level, actually, then it could be a signal that perhaps this range is going to revert back into the previous trend, which could be up. Notice, right? So when it hits the third level, it should bounce back at the second or first maybe and stay within that and then break or reverse like this if it breaks above the first one again, roughly speaking, all right? In any case, the principle is true that when you get to one level, it often goes back to the previous level as a retracement. So in this case, as you can see, when it breaks the third level, it even hooks back to the second almost. Here it breaks below the fifth, hooks back to the fifth, goes down to the sixth level. So now we don't have really great examples about the hook back, but basically when it does make a fall, let's say it goes from the third to the fifth, often when it goes to the fifth, it hooks back to the fourth before going to the sixth, or it goes to the third before going to the sixth. We don't have that motion here, but that happens often. Often you get price going to the second, back to the first, then to the third, back to the second, down to the fourth, back to the third, down to the fifth or sixth, then back to the fourth, stuff like that. What I mean is that when you move into the next zone, you'll get a retracement back to a level. Not always. Sometimes you skip one level like this. It goes from the third to the fifth, right? From the third to the fifth without really stopping at the fourth. That can happen. Sometimes you get bigger accelerations. All right. But often enough, are respected and they go back to the previous one, which is used then as resistance. So entry sometimes when price, let's say price breaks the third, goes down to the fourth, bounces at the fourth, goes back to the third, then this could be also good entries. The breakout below third, the breakout below fourth, the hook back to third or two, back down to fifth. The move when it goes to the fifth, hooks back to the fourth or third, again, one more downside to sixth. Those could be also entry potentials there. But entries, I would say, definitely be more cautious. I would primarily use it as a target tool. Entries are possible, but you really have to have a lot of experience with it. I don't want to beat around the bush here. I think it's very important that you know that. And definitely would only use it as a confluence tool at the very minimum, at the very maximum, sorry, before, and you'd have to build experience with it. But the target tool, I think, is definitely more usable from the beginning with less experience, because it's very clear and very, it's more straightforward, I think. Entries, be careful, very, very, very careful with using it for entries. But it is, in theory, possible, okay? Good. Let's take a look at more examples about this stuff. Let's take a look at the odd USD here. And let me put on a bit of a new chart like this. Good. Let's put on this top. Let's put on the script here on this top. Click on sell. We're looking. Right. That's the first level. Price stops at the second level. Did it stop at the third one? Interesting, right? As I said, it doesn't stop at all levels. Third one, it typically does, not in this case. And it went down right to the fourth level. You see that? So broke the second. But the thing is that it broke this. It respected the second and fourth, as we can see very clearly. It broke the first and the third, and it can happen. But look at what I consider to be the break. The important level, once again, is the third level, right? That's the important one. But look at how this candle is the one that is the breakout candle. It's the candle that has a close near the low of the candle, and the candle is, a decent amount of that close is below that third level. That's the candle that breaks that level. Once the candle is broken, though, you can look for pullbacks. Look at that, back to the third level, down to the fourth level. Now we're at the fourth level, looking for retracement back to the third for potential move down to the fifth level, which is all the way down here. That's the zone that could be possible, all right, for this odd USD. So you can see how nicely price uses those lines. Let's go and take a look at this upside. I made a beautiful trade on this upside. Let's put it. All right, now we're looking for upside target, level 1, level 2, level 3, level 4, level 5. Now, first of all, obviously, the first thing we see is how well their levels are respected. Look at the hit at 4, look at the hit on 5. Right. But what is the key level? 3, right? That's the key level of the breakout and the difference between range territory and impulse territory. Sorry about that. All right, so this is range, and that is impulse territory. All right, so price stops at 1, price stops at 2, doesn't stop much at 3, that can happen. And then it does push through 3 with this candle. As you can see, the candle close above the third level and a good close. So that's where we break through that third level. And price then moves up to the fourth level, almost hooks back to the third, and then there's that great breakout to the fifth. So what trade did I take? Well, I took the breakout of this bull flag right in here, and that was a great trade. The break of the bull flag indicating to me that there is that space up to the fifth level, and I capitalized on almost all of that space. I exited right about here because of the weekend that was arriving in a few hours, and didn't want to keep that trade over the weekend. So how many pips did I make? Well, I'll tell you exactly. I took it on this candle right here. That was the candle that broke this bear flag, because that's the candle where we had a clear candle close above it, above that trend line. That candle, I took it on, and I exited about here. And the profit of that trade was 120 pips. 120 pips. Right? So that was the trade. And it was all based on the fact that the third level was broken and that we were spaced up to the fifth level. And not only that, of course, but there was that bull flag. as I know that typically when price goes to the fourth level, it will hook back to the third or second before going to the fifth. Not always. You got to look at the higher time frame to make sure that the fourth is not a retracement level. And if it does break the first, then it's probably a different scenario here, right? But if you get something like this, a bull flag or bear flag, or you get a good bounce to the third or second level, those are good continuation signs that price has a good chance of getting to that fifth level. Nothing is 100% guaranteed, but there's a good chance. So I got the bull flag, I got the break of the bull flag, that was my signal, then boom, up to the fifth level. So that's another example. I think you get the point here, is that when we look at this, obviously, we looked at 5 things that we will learn, right? So now you know which level is the key breakout level for trends and ranges. That's the same for a 50-minute chart. It's the same third level, but the third level represents a different number of pips. Once again, on the hourly chart, it represents actually 144 pips. But on a 50-minute chart, it would actually represent 34 pips. Same level, just a different number of pips, right? All right. So that's the key breakout level. If you're looking for breakout trades, impulsive trades, it's good to look above 3 to 4, 4 to 5, even from 5 to 6. But we have to be aware that the higher we get, the more difficult it's going to become. Their gaps are getting bigger between 5 and 6 and 6 and 7. On the daily chart, 1, 2, 3, 4, 5, 6, 7, 8. These spaces are getting huge. So it's not easy for price to make a very impulsive move between 7 and 8 because there's such a great distance to travel. So if you get above 5, 5 to 6 is still could be very fluid, but often enough, the most impulsive is between 3 and 4, between 4 and 5. 5 and 6 can already take quite a long time before price gets to 6. And that's even worse with 7, from 6 to 7 and from 7 to 8. You have to realize that these are spaces that are so huge that you just can't expect price to move there in one shot. It might get there, but it's going to take a long time. So you want to be careful with that. And therefore, yes, we could expect a trend continuation, but don't expect it to occur that impulsively as between 3 and 4 and 4 and 5. So from that point of view, 3 and 4 and 4 and 5 are maybe the best zones. 5 and 6 is sweet, it's good. 6 and 7 is interesting, but it's just, it's very huge space and it's going to take time. So therefore, less interesting, I think, from a time perspective than 3 and 4. Now, if you're a range trader, you're a bounce trader, you might even think about trades in using 1, 2, 3 levels as support or resistance into the opposite direction, looking at it as a bounce level. I have not done that too often. I've more looked for breakouts and impulse continuations. So in theory, I think it's possible. It's just that I don't have practical much to say about it. I do think that price does respect the 1, 2, 3 levels, what I see quite reasonably amount of times. But it's not often that I trade those into the opposite direction. So if I'm looking for 1, 2, 3 upside targets, it's not that I take shorts at 1, 2, 3, but it's perhaps something that could give confluence for a range trade, reversal trade as well. That could be another idea, even if price gets to the fifth level, is not to trade target up to the target, but even use it as a reversal trade. Once again, something I've not really tested enough to say anything more than that. But those are concepts that could be used as confluence, though, right, in conjunction with other tools that you've tested. So I primarily use it for breakout trades from 3 to 4, 4 to 5, 5 to 6, and even higher. But those become, as I said, less workable zones, but still good information to know. Other ideas could be entries when retracing to 3, 4, 2. Reversal trades at 1, 2, 3, at 4 or 5. That's also possible, but as I said, needs more testing, and certainly be careful with those entries. And this is primarily a target tool. So that's the first thing, is the key breakout level for trends and ranges. Now you also know when to expect the bigger wins and when to think about letting the wins run. That's point 4. You also know when to expect impulsive price action and when you can expect more choppy movement. And on that note, I should add that on a 4-hour chart, if you're trading an hourly chart, it's good to look at the 4-hour chart and add moving averages to it. EMA close low and high, 21 EMA close low, EMA close. It's kind of like choppy. For instance, let me give you an example. Here, perfect example, like this. On a 4-hour chart, if you see choppiness like that, don't expect on an hourly chart that, or there's a higher chance, I should say, that price will not break the third level. It will stay within those third levels. And if it does move to the fourth level, there's a higher chance it will be used actually as a reversal back in the opposite direction. So if price action is choppy like that, be careful. Don't expect the breakout to occur. If price is trending like this, then obviously it's better to look for breakouts below the third level as a trend continuation. So it does depend also, like, what is one time frame higher doing? If the higher time frame is a choppiness, you might want to be on guard of expecting breakouts, and there's a higher chance that the range levels will be respected. If the 4-hour chart, if the one time frame higher is trending, there's a higher chance that we'll get the impulsive breakout above or below 3, and it's better to look for the breakout trade, I would say. Now, it's always one time frame higher. So if I'm looking at an hourly chart, I would look at a 4-hour chart. If I'm looking at a 15-minute chart, I'm looking at the hourly chart. If I'm looking at the 4-hour chart, I'm looking at the daily chart to see what the trend is doing. So 1-hour chart entries, or targets, I should say, I will look at the 4-hour chart and see how that chart is doing. If it's rangy, I'm careful with the breakouts. If it's trending, I know where the impulse zones should be, below or above 3, up to 4 or 5, and even 6. Also depends, the levels 5, 6, 7 depend on the currency pairs. An odd USD, well, it's level 5 is already a decent amount. Level 6 is really great. It's not going to go to a level 7 that often, or level 8, because it's not a big moving pair. But a pound yen flies like we've never seen before. It's just sort of like a Ferrari, right? So a level 6 is like a level 5 for an odd USD. Level 7 is like this level 6 for an odd USD. The pound yen is going to hit level 5 easy, very easy. It's going to hit level 6 also easier. Every level is going to be hit easier. In fact, it can even go to a level 8. I've seen pound New Zealand move to a level 8. So it's kind of like the pound yen, the euro yen, the pound odd, currency pairs that you can consider the levels to be one higher. Now we talked about how to use the entries with caution once again, and how to use it as targets. Okay, so I think we've covered all the things that I mentioned in the list that would be explained here. Now, there are some things still that I need to talk about, though, that have not been mentioned in the list. And that is, well, actually still probably an important basic rule, actually, that I have kept for this end, is when do you start using the script and when do you start to use a different script? I use one script per pair, but that's actually, it's just practically, you cannot really do two on it. So when do you use an upside and when do you use a downside? And when do you change it? Right? Those are important questions too. Now, so far, you've seen me place it on the chart. But if this webinar is over and then you start to put it on the chart, you might be wondering, wait a second, where did Chris put it on and why did he put it there and what do I do next? So if you bump into these questions, don't hesitate, once again, to write us an email. I'll explain how to do it in a second. But even despite my explanation, you might have questions. So once again, if you have any questions, do not hesitate to write us. That's why we're here. We want to help you with this. So write to info@elitecurrency.com and we'll help you with that. The screenshot, where should I put the script? There, and we'll help you. Right? So far, we've been using tops and bottoms, and those are very natural spots to put the target tool. When we're looking at this 4-hour chart, it will be I'll use this top right in here, and I'll use this bottom. Those are good spots, in fact, to use it. Natural tops and bottoms always make sense and are never 99.999% should be okay. So that's one thing, naturally using those tops and bottoms. Now, what is a natural top and bottom? Because you might be wondering, hey, I'm looking at this chart. Do I use this top or this top? Or should I even scroll further back? The answers to those questions. First of all, you want to use the data that you see on this chart. That's the data that's relevant, not keep it where it is. Any top or bottom, any low point of this chart could make sense. So what is the low point on this chart? Is here. What is the high point? It's here. Using those levels always makes sense, really, to be honest. But if you see a level here and then you see a big bottom here, you could also use it there. There's nothing wrong with using the second one. It's, anyhow, almost a double bottom. Now, those are natural tops and bottoms. Let's give it more examples here, maybe on the pound USD. So what are levels you can use that tool? Well, you can use it here. You can use it here. You could have used it here when price was in this part. Not anymore, because the new bottom is where I have the arrow. So you can use the tool for downside targets from 0.1, for upside targets from 0.2, or even for downside targets from 0.3. From there. That's also a top and bottom that I think counts. And I'm just looking at how important is that level. Very simple. Those would be 3 natural spots where you can use it, no problem. You can even use it here, but you have to realize that that's not a bottom that's really confirmed. So this is eyeballing it. But I also use a more less discretionary rule. And that's when I start to put on the chart the 144 EMA and 169 EMA. Let's put that on. Let me remove EMAs and only keep those 2 on. There we go. Those are what I call the tunnel. 144 EMA close, 169 EMA close. Kind of the reset. This is the long-term moving average, or maybe the intermediate moment, because this is where we have the mean of the intermediate price. Naturally, price will gravitate back to this 144. From it, it can. It's a breakout, it's an impulse, but eventually, after it has moved to the 5th or 6th level or 7th level, back to this mean. That's how it works. Price moves away from the mean, goes back to the mean, goes away, goes back, goes away, goes back. So I like to these levels from the moment the price touches the long-term mean, because I'm counting how far can it keep pushing away from the mean. If it's back to the mean, I reset the count. Let me show you how that works in practice. Let's go back in time a bit here. All right. And we see, and here we had a price pushing away from the mean, the long-term mean. All right. So what I could do in this case on the hourly chart, places where I would put the fib, the Forex Wizz, the script, is from the top. But I can also use the top that's closest to the mean, which is this one right in here. The top, the fractal closest to the mean, which is this one. You might say, hey, this one is closer. But that one, I don't use this one because this fractal pushed through that fractal, which means that fractal is broken. I use the fractal that's not broken. So that's why it's this fractal. And I start counting from there. You can use both spots. But this is the reset. As soon as price pushes through the tunnel, that's a reset moment that you could use. So let's do that. Let's put the fib there. Here. That's the top. And you'll probably see that price breaks through the third level. When it breaks through the third level, obviously it broke through the third level. When you see that happening, you will see that price is getting into acceleration and then breaks through that that tunnel. So I have the good. Move averages away again. Get a tool. Good. Level, the key breakout level was at the tunnel. And when it broke below the third tunnel, the third level, it also broke below the tunnel. Beautiful, right? Where was the impulse? Between 3 and 4, and between, look at that, right down to level 5, right? Now I didn't get all the way up to 4, as you can see that these retracements don't have to be deep. Here it did get up to 2, so it moved down to 1, skipped 2, went down to 3, went back up to 2, and went from 2 all the way down to 5. 5, it didn't go up to 4, but then what did we get? It did move all the way down to 6. In which manner? A choppy manner, as I already said, because the zones get wider, and therefore you'll see a less impulsive move. Between 3 and 5, you'll see you can definitely see moves like that. Another beautiful example of downside. And once price then gets, you should expect a retracement of 5. Once it breaks below 5, like it does here, we have the blue arrow. You'll probably see indeed something like, most of the time it's more of a channel like this to the downside. Still using 5 now as a resistance, and ultimately stopping at 6. Beautiful classical situation here going on the pound USD. So that's one way you can use this stop and keep using that. But I also represents the ground at the tunnel. And in that case, let's see. This is a bit annoying because both of them are on, but hang on. All right. Here we go. 1, 2, 3, and top, the new top, from 3 to 5, from 3 to 4, 4 to 5, pretty impulsive as well. Right? So those would be the new reset moments. Now, why is that important? Because as long as price doesn't touch the long-term moving average, we can keep the fib tool here, or use both. We can keep it there. We can keep it there. We can keep it there. Keep it there. As long as price doesn't go back to the tunnel, we can keep it there. We know that there could be the next target in play. But as soon as price gets back to that long-term tunnel, this tool at that level, or those levels, is not valid anymore. And that's the reset moment. Because otherwise, if we leave it there forever, well, price could get eventually all the way up down to 15. Who knows, right? But no, that's the moment. That's how long it's valid. That's how long the tool is valid. As long as it doesn't touch the tunnel, it's valid. Once it gets back to the tunnel, oh, that old one is gone. So that's why I'm talking about the fact, like, okay, price can get up to a 5 or 6 or down to a 6 or 7 on the pound yen, but then that's it. And why? Now you understand, because price has gone back into the tunnel. And then it basically, price has moved away from the tunnel and it got to 5, 6, 7, and then went back to the tunnel. And it wasn't able to get down to 8, 9, 10 without hitting the tunnel. All right, that's the point. That's the reset moment. Tool, because look, this is moving down away from the tunnel. How far will a correction go? Well, to level 1, 2, 3, 4. 1, 2, 3 often enough, so I put on the tool for upside, looking for the correction level. Couldn't escape level 2 before it moved down again. And when you use this tool from this bottom, or from this bottom, or from this bottom, or from this bottom, you know that it should not exceed level 3 in most cases, and definitely not level 4. And that could also be, in some cases, valuable information for trend continuation. Another thing I look for is it crosses through the tunnel. As soon as that happens, we can expect a bigger impulse to happen. Or at least there's a good chance that the previous trend is out of the focus. Because if the 8 EMA is still above the tunnel, the downtrend is really not confirmed. 8 EMA has to cross below the tunnel before the downtrend is confirmed. Same for the opposite side. 8 EMA has to cross above the tunnel before the uptrend is confirmed. The downtrend is for sure over, like happened here. Right? So level 6 got hit. We know level 6, we can see a bigger retracement on level 6. So level 6 side target, we shouldn't expect price to trace back to the 3rd level and move down again. We got to be more cautious, and we could expect a bigger retracement. Expect level price to go up to level 4, right? And indeed, look at that. 1, 2, 3, level 4. Stop right at level 4. Went to the tunnel, and that means that price is now in a limbo territory. Either it's going to break above 4 to go up to 5, because we're already in an uptrend here. We're looking at this bull flag. Or price is going to recross below the tunnel, and we restart the bearish count from here. We would move the tool from this top on the left to the top here and start counting as soon as it breaks these levels for downside. Or this is kind of like an either or moment, right? Or we get the upside break above this pull flag and we get to move up from 4 to 5. Which did happen, but it took time. And this is something I didn't know beforehand. We've had a lot of good examples so far, and this is an example where it ultimately didn't break this double top. So you got to be also aware of the fact that it's not magic, and that sometimes it will not reach that target, and you got to keep an eye on, indeed, if it takes too long. Look at this double top, but also the fact that it took about 2 days of price action going sideways. That's already a bit of a warning sign. Be careful with the time factor as well. It made a deeper retracement to 3 and then ultimately did get to 5. All right. So there you have it. That's important. The tunnel is important for measuring spot. I'm going to look at this now and say, okay, where do I use the tool? What would I do? You can see that this bottom makes sense. This top makes sense, but also here makes sense. And here, because those are the fractals that are at the tunnel. Here, any of those fractals at the tunnel makes sense. All right. Now, this is a great tool, and we have more tools on our website. In fact, you could use, for instance, and if you're interested in this, by the way, you can go to our website, you can click on FX courses, you go Forex Wizz Fib targets, and you can see that you can buy the script. You already have the knowledge, so you can use it freely and use it like that all you want. But the Forex Wizz, all it does is help you automate this process by putting the lines on the chart. And that is quite useful. We've done it for ourselves and it just makes things easier. So if you're interested in that, you get a discount, not 139, but only 79 euros. You can buy that. And it just saves you a lot of time and does a lot of good. The knowledge is yours. You can use it forever. I would ask you to be discretionary with it because it's very valuable knowledge. I would advise you to be cautious with it and only pass it along to people that you really think deserve that knowledge. But if you want to order the hopeful tool, that's why we have it here. If you want the script, then it's only 79 euros and one-time fee. No strings attached. That's it. One-time thing, and you can look at more information there on Forex Wizz Fib Targets. Now, don't move away quite yet. There are other things that are new on our website. We also have an accurate pivot point indicator, which you can purchase, but also the Forex Quant calculator, and that's a perfect kind of tool with this tool. It's basically when you order Quant, you get this tool included. So it might be smart to go for Quant because you don't get only the tool. You don't only get Quant, but you get Wizz as well. All right, so there's a benefit in that. So now it's just a bit more expensive, but you get the tool included. And what is Quant? Well, basically it helps you calculate the odds of success relative to your trading style on each setup. So what you need to do here, you can see how it looks like, and it allows you with a few parameters to calculate what is the chance that this trade is going to work out. Well, not the chance that it works out, but it gives you a percentage, and the higher the percentage, the better. But you have to make it relative. So you have your strategy, you have a trading plan, and for instance, on average, you see that your trading is giving you a 60% win chance. And if this setup has 80%, then you know, wow, this setup is actually doing a lot better than the other ones, right? So it gives you kind of a relative idea. And the cool thing about it is it's a real percentage. In trading, so many things are just guessing. I think this is going to be a good trade. The technical analysis shows me that this is a good setup. But still, you don't have a concrete, factual number. And Quant does that. You type in the currency, this is the euro dollar, you say what the number of spread is. You just type in quickly, you know, what is it, buy, and you write down the level of your entry, and you write down the level of your stop loss, and take profit, right? Very simple. Where is the support level, the key support level that you think is important, for instance, right? The resistance level that you think is important. Price action, I'll explain what that means, but if it's bullish or bearish, basically, all right? And the ATR. That's it. And you click calculate, and you get a percentage. And it says, wow, 76%. That could be good. Most of the time, that would be good, right? But if it's 50, it could be good for you, but bad for someone else. It's all relative. And then, not only that, but you can update the trade as you go along. Okay, how many bars have been open? This is trade management. What is the new ATR? What is the current price? What has a trail been used? And you get a new percentage. Let's say, all right, that's the new trade development, the trade management. I click again on calculate, and this percentage went up from 75 to 84.5. Did you see that? That's because the trade was going our way, so that it will factor that in. So, you know, and you have 3 tabs here. So that's pretty cool. That's how it looks like. That's Quant. And you can find that too under FX courses, FX Quant Calculator. All right, and you can click on order now here, or click on order now here, and you will be brought to that ordering page. And you can see that if you go for 5 months, you not only get Wizz included, but you have 5 months of Quant, all for 179 euros. So for 100 euros more, you not only have the Wizz, but 5 months of Quant you can try out. Or you can try a demo. Try it for 2 weeks. The Quant I'm talking about, the Wizz is unfortunately not available as a demo. But if you want to try out Quant, you can do so for 2 weeks. No strings attached. You try it out, see if you like it. If you do, great. If not, no problems. All right, for those that already have Quant and have already received it, this is how you install it. Go to your download, go to files, click on take and cut file that we sent you and cut it or copy it. All right. And bring it, as I said, you have to open this file and then you get the MT4 file of your choice. Go to MQL4, double click with the left mouse button on it. Double click on scripts and then paste it. You can either right click and click on paste or click on Control V to paste it in this folder. Close MT4, clicking on the X, reopen it. One, click on it, holding with the left and only release when, but release it at a point where you want the indicator be, where the script should be, according to what I just explained, and let go there. You'll get this. Click on buy for upside targets, sell for downside targets. You can change the colors if you want. Click on OK. It's that simple. And I think more than enough, 1 hour already. Sorry for that. It's a bit on the length things regarding this tool. And I wanted to make a real, webinar that really discusses all of the angles before, but it was a pretty fast one, and several webinars, some aspects of it. Wanted to have a webinar that really touched all of these things. I might have even forgotten one or two that I'll think about later. In that case, I might even do a second webinar a month, 2-3 months from now, if I think about it and have enough material there, or maybe an email. I think a lot of things haven't covered. Now it's up to you to test it, try it. Don't underestimate that. Work with it. Send us your feedback. We love to be in touch with traders. We want to be in contact with you. We want to know how you're doing with this and your trading in general. So don't hesitate to do that. You're not bothering us. We actually enjoy the communication and want to know how you're doing, even if it's just a simple hi. We really appreciate that. So info@elitecurrency.com. We all wish you a pleasant weekend, good trading, and hope to see you on Monday. Don't forget Monday, we're gonna and talk to Dale Pinkert from FX Street. Let's see, I'm trying to pull up, there it is. You can go free resources, right? One more thing maybe I want to talk about is, before we push off, is there are a lot of free resources here. Ebook, strategy, Camarilla, and you can actually get our systems for the discount if you open an account with Admiral Markets, and you'll get actually the volume you trade, you're going to get a discount on our product. So that's great. There's a lot of webinars here you can find, a lot of free stuff. So really take your time to go through it. I know that we don't have patience nowadays to really examine a website. We want to see everything in 30 seconds and then just close it. But I encourage you to take a look at the blog, take a look and discover this website. There's a lot of things out here. Also regarding Forex courses, tools and indicators that help you, and testimonials. Just take a look at this. Also, of course, the free webinar with Dale, as I will just show you in a second. And last but not least, take a look at our YouTube channel. Here you got Dale Pinkert from FX Street. Dale is the anchor and host of FX Street's live analysis room. Monday, 2nd of November. Take a look. Same website here. And we got our own YouTube channel, of course. And I recommend taking a look at that. You can see a lot of info on that as well. And you can go to YouTube. Well, it's taking a bit long. Well, we have a YouTube channel. Just click on elitecurrency.com when you're at YouTube, and you'll find that. All right. Once again, see you soon, and good trading. Cheers.